What are the basic investment products? Usually there is a trade-off between the return you can make and the risk you run on your investments. The safest investment choice is cash held in an easy access or fixed-term savings account. This is especially true as you get nearer to retirement, when you need more financial stability and it's more painful to recover from an investment gone wrong. While holding cash is a relatively safe form of investing, the trade-off is that returns tend to be low. Other than cash, there are three major investment products to choose from: funds, bonds, and equities, also known as stocks and shares. Bonds are a low-risk investment option as they provide a steady return on your money. A bond is a loan from an individual investor to a government or company known as the issuer. The loan is for a predetermined amount of time, known as the maturity or term. This can be for any length of time, typically between 1 and 30 years. In exchange for the loan, the issuer pays the investor interest. This interest is paid out at regular intervals. Fixed-rate bonds pay a fixed rate of interest, while floating bonds have a fluctuating interest rate, which can be linked to a number of factors such as inflation and the stock market. Government-issue bonds are the safest and are therefore called risk-free bonds because it's highly unlikely for a government to default on payment. Company-issued bonds carry more risk, which is monitored by credit rating agencies who assess whether the issuers are able to service their debts. When the bond reaches the end of its term, the issuer promises to pay the investor back the face value of his investment. Funds diversify risk by spreading your money across a diverse mix of investments. The simplest and cheapest type of fund to invest in is an index tracker fund. An index tracker usually follows a national stock market index, which is made up of shares from a country's most important companies. Therefore, as long as the stock market is growing, your money will grow along with it. The alternative is to invest in a managed fund, which typically holds between 30 and 100 different investments, including shares, bonds, property and cash. However, funds can be expensive, so always ensure you understand the fees charged before investing, as they will eat into your returns. Funds are best suited for a long-term investment for over 5 years or more. Some funds are designed to generate a steady income. Others are higher-risk investments designed to grow. The value of your investment in a fund at any given time will depend on the performance of its portfolio of investments or by the demand for the fund itself. A share represents a percentage part of a company. If you buy a share in a company, you own a percentage of it. Shares may provide a return for investors in two different ways. Firstly, the value of shares will grow or shrink with the overall value of the company. This is determined by how well the company is expected to perform over time. Whether an investor makes a profit or a loss depends on the value of their shares at the point they choose to sell them to another investor. Secondly, if the company prospers, the investor will receive a share of any profits that are not reinvested back into the company. These profit-sharing payments are known as dividends and are paid at regular intervals. Shares can be bought in a huge variety of companies, from small startups to huge multinationals. Each varies in value, growth potential, and in risk level. However, all shares carry significant risk. They can go up in value, but if you get it wrong, you could lose money. Selecting individual shares is risky, even for experienced investors. If you're just starting, you may want to begin with an index tracker fund, managed fund, or bond.